morning to welcome and open our proceedings. We will welcome none other than our Senior Vice President of the Trinidad and Tobago Chamber of Industry and Commerce, Mr. Charles Pashley. Please welcome him.
Hi, good morning. Salutations. Brent McPhee, Chief Executive Officer of the Home Mortgage Bank. Mr. Osmond Pravat, Manager Fund Management and Capital Markets, Home Mortgage Bank. Mr. Prakash Ramlakan, he's a lecturer at the University of the West Indies. And of course, last but certainly not least, of course, Ms. Trudy Telesford-Pear, she's the President of the Security Dealers Association of Trinidad and Tobago. Welcome, ladies and gentlemen. We actually had quite a few more people registered than have actually attended, which was very heartening to see the interest in the event. The traffic situation, I think, has challenged a couple of people, and we didn't think we could wait any longer to start. But I'd like to welcome everyone, and it's very heartening to see people interested in an event such as this, which I think is a good opportunity. We're all aware of the conditions in Trinidad and Tobago where things are a little bit on the tight side. And this has forced businesses to rethink their strategies and cost. Although the approach to spending is conservative at present, the private sector is always looking for feasible investment opportunities. I expect that the information presented here today with this session will be a viable opportunity for those ready to invest. Housing is one of the major needs for the citizens of Trinidad and Tobago, and access to home ownership can be challenging at times. The information that will be presented this morning is another way we can encourage home ownership and at the same time promote viable investment opportunities while also positively impacting the bond market. So we get three benefits all in one from one strategy, which is an excellent opportunity. Today's session is part of the Chamber's goal to bring information to our members that helps make the most informed decisions to help their businesses grow and develop. We offer a range of services, this being one of them, and we are constantly striving to increase the value we present to our members. We encourage you to continue to make these free sessions and our other upcoming events, such as the post-budget analysis meeting, which we will be having on the 8th of October. And it's the only meeting that has the Minister of Finance present after the budget. So it proves to be a very valuable discussion with a number of business leaders and with the Minister of Finance. So we look forward to seeing you and your other team members at that event as well. But I'm sure you're looking forward to seeing and hearing a lot more about the mortgage-backed securities, which is a potentially valuable contributor to the construction sector, home ownership, mortgage facilities, and also the bond market. So I'd like to welcome you all and thank you very much and hand you back over to the moderator and enjoy the session. Thank you very much. Yes.
Thank you very much, Mr. Pashley. Now, coming from his remarks, we would get that conversations like these need to happen. So, as I said from the beginning, I hope that the faces are more enthusiastic as we proceed this morning. I now welcome none other than the CEO acting of Home Mortgage Bank, Mr. Brent McPhee, to bring opening remarks from the Home Mortgage Bank.
Thank you, Chantal. Good morning. Ms. Trudy Telesford-Pear, President of the Security Dealers Association of Trinidad and Tobago. Charles Pashley, Senior Vice President, Trinidad and Tobago Chamber of Industry and Commerce. Directors of Home Mortgage Bank and Trinidad and Tobago Mortgage Finance Company Limited, Mr. Prakash Ramlakan, lecturer at the University of the West Indies, St. Augustine, Mr. Osman Privat, manager fund and capital market, members of the media, specially invited guests, ladies and gentlemen. Good morning, everyone. It's a pleasure to welcome you to the Home Mortgage Bank panel discussion on mortgage-backed securities and its role within the capital market. Just to give you a little idea or a little background of Home Mortgage Bank, the Home Mortgage Bank was established in 1986, that's just about 33 years ago, by an act of parliament with a mandate to develop a home mortgage market and maintain a secondary mortgage market in Trinidad and Tobago, to contribute to the mobilization of long-term savings for investment in housing, to support the development of a system of real property and housing finance, and provide leadership in the housing and home finance industry, and to promote the growth of the capital market. This morning you will hear we will touch on all aspects of these the mandates that we have as an organization. You will hear from Osman and the panel on the mortgage-backed securities, and you'll also hear from Rolda on the commercial business. Home Mortgage Bank is 100% owned by the National Insurance Board of Trinidad and Tobago. HMB's core business include commercial and corporate credit and asset-backed investment securities. Some of you may recall HMB providing residential mortgages. However, in 2017, Home Mortgage Bank executed a Memorandum of Understanding with Trinidad and Tobago Mortgage Finance Company Limited, TTMF, and as a result, HMB transitioned to commercial mortgages with emphasis on housing developments, project financing, and public-private sector partnership developments. HMB also provides investment opportunities, and its existing product offering includes mutual funds, bonds, and CMO investment certificates. HMB is the only financial institution within Trinidad and Tobago distributing mortgage-backed investment securities, investments that are ultimately backed by real property. We understand the importance of prudent investment decisions in these challenging economic times to maximize on you and your company's returns. When a decision is made to invest, you will want to know that your investment is safe, secure, and provides a steady return. HMB provides that stability and peace of mind in its investment products. Diversification is the key to ensuring minimum risk and overall balanced investment portfolio. Mortgage-backed securities provides an alternative to be included in your investment basket, providing investors and organizations with an opportunity to select from a variety of investment options, along with varying rate of returns that is ultimately backed by real property. Today, it is our intention to have a conversation with you and provide you with the relevant information on mortgage-backed securities and the benefits that can be derived from these investments. Now that you have had your breakfast and your coffee and everybody is ready to absorb, sit back, relax, and allow all the information to be absorbed. Again, welcome to the first installment on mortgage-backed securities, its role in the capital market, and an investment alternative. Thank you.
Thank you very much, Mr. McPhee. Again, conversation. So this morning really is intended to be an interactive session, and I'd just like for thought to plug in what Mr. McPhee said: diversification is key. We now welcome Manager of Fund Management and Capital Markets of HMB, Mr. Osman Privat.
Good morning, all. Members of the Chamber, directors of the HMB board, CEO, Mr. McPhee, and the panelists. I also want to give thanks to Trudy and an additional shout out to Prakash because, he got admittedly a last minute call, and he still, he agreed. And, I think we as a group will be better off for hearing what he has to say this morning. But at this point, my role is just to give a broad overview of mortgage-backed securities and how they fit into the HMB business model. All right, so the HMB mandate, the HMB mandate, as Brent was saying, is to develop a secondary mortgage market, promote growth in the capital market, and develop long-term investment in housing finance. And in fulfilling that mandate, we would have developed over time an array of investment products, starting with, we would have had mortgage participation certificates. We also have a mortgage participation fund, collateralized mortgage obligations, and a big part of our investment portfolio, of our investment offerings as well, would have been bond issues, right? Both taxable and tax-exempt bonds, right? And those provisions would have been as part of the Act. So the bottom line here is that those securities are designed to meet our objective of developing the capital market and promoting long-term investment in housing finance, right? Just an international perspective as we look at how it could relate to our own local market. The chart that would be to your left really represents two things. It represents the residential mortgage market debt in the US, which would be the blue line, and the gray represents the level of securitization within the US market, right? So the US market would have been chosen for two reasons. Well, this is the deepest, it would have been one of the deepest mortgage markets and one of the deepest in terms of securitization. And what you would see is that as at the end of Q1 2019, you would see that the securitization of residential mortgages is close to 90%, right? So that says that a lot of the mortgages that are originated, ultimately, they don't sit on any one bank or credit union balance sheet per se, right? They are securitized, which in effect brings additional liquidity into the mortgage market, right? And that liquidity would provide a number of benefits in terms of available financing, the rate at which the financing is offered to investors would be lower as well. And another big positive for mortgage-backed securities is in terms of the investment offerings, the strong credit rating and worthiness of those investment offerings, and the fact that they are able to meet regulatory requirements for institutions, right? Bring it back home to our local environment, we will say that mortgage-backed securities is what anybody who in the origination space was called, we would design them to be statutory fund admissible, right? And if some of the treasury managers could be a little braver as well, then we could say they could also use them as part of the reserve requirements depending on the credit ratings they carry and so, right? The next, the chart on the right-hand side really represents initiatives in terms of securitization versus mortgage insurance. And so basically it would have been initiatives utilized to help develop the securitization space and financing for the real estate market. So you would see in Canada they would offer basically what we would call, say, credit insurance on mortgages, as opposed to they would provide the opportunities for securitization. You see the U.S. is much larger in terms of securitization versus insurance, right? And I took it from a public point of view, meaning to say these would have been initiatives driven by public sector policy, right? Bringing it back home to us, we would see that from a public sector point of view, we have a much lower level of participation in terms of what we do, right? We would have issued mortgage-backed bonds. So from a public sector point of view, you would see institutions like TTMF, HMB, issue mortgage-backed bonds, right? But in terms of securitization, there's a relatively low level of securitization of those mortgages that they put on their balance sheet, right? Our plan going forward is to increase that level of securitization of mortgages, right? Ultimately, the objective is to develop a secondary mortgage market, drive liquidity into the real estate market, and make home financing affordable for Trinidad and Tobago nationals, right? So we would have, any Google search and you type in mortgage-backed securities, you could initially come up on some fairly bad news, right? And one of the key things we want to point out here is that the product and the model of the product in itself is not bad, right? It's basically what you put into it. So you hear the term often, garbage in, garbage out, right? So if you underwrite mortgages and ultimately they don't meet proper underwriting characteristics, then it's garbage in, and ultimately the garbage out would be that nobody could see the cash flows coming through on the next side. People walk in and leave the keys, and banks have no choice but to realize the security, and depending on how much of a wave that is, then everybody loses, right? So when we are looking at securitizing mortgages, especially through our CMO product, right, which is really our intention is to take the level of participation in the market for CMOs up significantly, right? We would look at, these are some of the criteria we would look at in terms of collateral considerations that we would consider, right? You look at the size of the mortgage at any one point in time. So whether it be we're looking at a mortgage pool of 1,000 mortgages or 500 mortgages, we have certain size restrictions, right? You wouldn't want anything, say, less than 100,000, as well as chances are you're not going to put a mortgage on the books that is $2.5, $3 million, as the case may be. We have our preferred sizes that we would look for. We also have, in terms of payoff, how much in terms of the time to maturity for the mortgage, right? We have our preferred time bucket as well, and ultimately, what we're looking for is mortgages that are amortizing on a monthly basis, right? So, yeah, there may be instances where clients may want some form of structured mortgage where they may be interest only for a point in time, they are allowed to repay in lump sums and so. That might be fine, but when we are doing a securitization, those are not the mortgages we're looking for, right? We're trying to keep it at a strong credit quality, and ultimately want to make it simple for potential buyers to understand what we're doing. So we're looking at mortgages that amortize monthly, right? We also look at property type, not so much so in terms of we come to take a look at your house, but we also look at where they are and in terms of whether they be individual units versus a development, as the case may be. And with respect to property type, I should also say we pay close attention to the geographic concentrations within the portfolios, right? Those are taken into consideration. So we wouldn't go do an entire deal on, say, a Greenvale housing development, as the case may be, which could have implications for the investors, right? And one of the critical things we look at is loan to value, right? You'll see, we actually have an issue in the market right now, and on average, we will say the loan to value is around between 46, 52%, which means to say that the persons we are putting into mortgage pools for securitization, they have a level of equity built into their mortgages, right? And that equity ultimately would provide some incentive for them to continue to pay, work something out if they run into problems, as the case may be, right? And key in terms of the underwriting is what we would measure in terms of total debt service ratio versus gross debt service ratio. So prior to even getting into our security, those would be the characteristics we would look at, right? After doing so, then we would project out the cash flows and depending on how the cash flows are projected, then we could determine different investment opportunities, right? So just a little graphical representation of what we see, right? On one side would be our projected mortgage flows, and on the next side would be the different investment opportunities that could play out from a possible mortgage pool, right? So in terms of the securitization process, if I wanted to summarize there quickly, right? Prime mortgages, right? Meeting conditions that would have been set by the home mortgage bank, right? Projection of the cash flows, right? And on the issuance of the security, right? This is a biggie for investors. On the issuance of the security, the mortgages are moved into a separate trust, right? So there is no HMB no longer owns those mortgages, right? The cash flows for those mortgages don't come to HMB as the owner of the security, right? So in the event that HMB moves in or HMB goes into any form of liquidity issues, credit issues, as the case may be, there is no recourse to those mortgages, right? Those mortgages belong to the investors in the CMO pool, right? And thereafter, basically, the cash flows that are generated from the mortgage pool are returned to investors, right? You as an investor, you could choose how you want to invest, which would determine when you get your cash, right? Some of the risks and quickly some of the mitigating factors in terms of investors. This is what you would see. I mean, in your opener our prospectus, you will see it as well. You face credit risk, right? You would face some level of liquidity risk, interest rate risk, prepayment risk, right? In terms of credit risk, we mitigate that by the quality of the mortgages we would put into the mortgage pool, right? And for liquidity risk, in terms of for individual investors, the bank will make a market. Meaning to say, we will repurchase CMO securities from individual investors. However, we believe that the institutional investors, they have a command of our local market, and they could make a market for themselves, right? So interest rate risk is fairly limited, but the security is built as floating rate mortgages. So there's a pass-through. So the mortgage rates go up on the pool, the investors will benefit. Mortgage rates come down, the investors will lose out on that in that instance as well, right? And one of the key risks, not necessarily mitigated in the product, is really prepayment risk, right? Because you choose your investment option, which means to say that you could choose what time bucket you want to receive your cash flows in, right? So it's basically a risk that you kind of expose yourself to. So if you wanted your money early up, you go into some of the earlier tranches, right? Whereas if you wanted a long-term investment, you could have gone into an investment opportunity for a longer term and a longer rate, and a higher rate, sorry. Right? In terms of investors, these are some of the potential investors that we are targeting with our products, right? Our mortgage-backed securities products, from mutual funds to CMOs to, when we do bonds, we're looking at pension funds, right? Mutual funds, individual investors, institutional investors, right? I would also say that depending on who you are, a credit rating may mean something to you, and the CMOs are rated by CARICRIS. Right? We have one in existence that's rated, and the commitment from the organization thus far is the securities that we do put forward would also be rated. Right? And that was our short brief on mortgage-backed securities. Right?
Thank you very much, Mr. Pravard. We swiftly move into our panel discussion, and I take pleasure to introduce you, firstly, to Mr. Osmond Pravard, who holds a Bachelor of Science degree in Management Studies and Finance from the University of the West Indies and a Master's in Business Administration from the Arthur Lockjack Global School of Business. Mr. Pravard joined the bank in October 2015 in the post of Manager, Treasury and Investments. He now performs the role of Manager, Fund Management and Capital Markets, responsible for the bank's securitization portfolio and funds under management. Prior to his appointment at HMB, Mr. Pravard was the portfolio manager at a local broker-dealer. Mr. Pravard is also a current member of the Securities Dealers Association of Trinidad and Tobago. Please give him a warm round of applause. Mr. Prakash Ramkalawan is a finance and investment professional with significant training and experience in banking, finance, and education. He has spent several years at the senior managerial profession capacity in key sectors of the domestic finance industry, including credit union, commercial bank, merchant banking, and the central bank. His exposure covers examination of banks and non-banking financial institutions, includes credit, liquidity management, performance evaluation and governance, investment management, international debt and equity portfolio, MSB and options trading, asset liability management and risk management, amongst other areas. Mr. Ramkalawan is currently a full-time lecturer at the University of the West Indies, St. Augustine, Department of Management Studies, where he lectures in finance and banking. He has participated in several seminars where he presented to investment and finance leaders, professionals in Trinidad and Tobago, the Caribbean, Central America, and the USA. He has research interests in finance and investments as demonstrated by his academic publications in those areas. Certainly, last but not least, our only female member on our panel this morning, Ms. Trudy Telesford-Pierre. Ms. Pierre is the president of the Securities Dealers Association of Trinidad and Tobago, its first serving female for the term of office covering the period 2017 to 2019. She is the deputy CEO at KCL Capital Market Brokers and sits on the board of directors as the company's corporate secretary. She also heads the company's enterprise risk, legal, and compliance division, including formulation and execution of the company's corporate governance structure. Mrs. Telesford-Pierre is a fellow of the Association of Certified Chartered Accountants of the United Kingdom and a member of the Institute of Chartered Accountants of Trinidad and Tobago. This gives you a good feel of the expertise this morning, and I now welcome you to our panel discussion. First question, please. What are mortgage-backed securities?
All right. Well, I guess I will kick off the discussion. As you would have seen in the presentation, right, mortgage-backed securities are really investment opportunities that would have been securitized, collateralized, or backing, or I should say backed by mortgages, right? That is the simplest, basic description of a mortgage-backed security. It would have been somebody taking a mortgage, four of us on the panel here, and the cash flows from those mortgages are what the investors would buy in.
Any one of our panelists wants to join in?
Generally, Osman has basically covered it in his presentation and in what he just said. It really is an opportunity for the public generally to be part of the development of housing within a country. And what it does is it allows the entity that has the expertise to administer those mortgages to focus on that and let the funding side be separate. And as I said, inclusively of the public to invest. So that you're very sure of exactly what you're investing in. Because the end result is, as Osman has said earlier, is that property is really what you're investing in at the end of the day. That is the asset that is backing everything that you're invested in. Because if anything happens, that's what you have to look at. What can be liquidated in order to give you back your principal, at least your principal sum, right? The diversification aspect of it, I guess, would be discussed further in the conversation.
Well, you all are free to join in.
I think it's well articulated, so I'll let it rest there for now.
All right. Basically, I guess for Sudi and Prakash, in terms of what are the different forms of mortgage-backed securities you guys would have seen out there. I mean, we would have discussed what HMB offers, right? What have you guys seen in terms of mortgage-backed securities and the form they take?
Well, I would have seen basically the entire waterfall from the US market. It's quite complex, and these structured notes have attached derivatives to their mortgage cash flows that created highly sophisticated instruments in terms of their risk and also the valuation. So it provides challenges. I think what has happened is that the marketing of these securities tend to focus more on the return as opposed to the underlying structure and the inherent risk. And that's where a lot of investors across the world got bitten 2008, 2009, because they have performed very well. But remember, like any other market, there is a certain amount of momentum that will take it up, but at the same time, if that momentum is not maintained, it's going to descend. So you have to understand how these securities fit within your overall portfolio, and in particular, how it sits with your risk profile. So what you have articulated in your presentation seemed to be the basic, the plain vanilla. So you start with a basic structure, which I would strongly support, and as knowledge of the industry grows and complexity of the investors increase, you can now structure new products to meet the desires of those investors. Some of the complex ones I would have seen relates to the leverage notes, the inverse floaters, the leverage inverse floaters as well. Our interest rate environments and our derivative markets don't support that type of structure. So let's keep it plain vanilla for now.
Well, you can't touch that brilliance, right? But generally, if you just piggybacking a bit on what Prakash would have said, if you look at what was presented with respect to the risk assessment, looking at what is looked at when determining what goes into these portfolios, you realize that it gives a broad spectrum of basic stuff that is critical that you may think. A lecturer once told me, just state the obvious. It may seem very obvious, but it comes back to the basic thing that impacts the viability of what you're investing in. So when you look at concentration, which was also spoken to, concentration also comes all through the risk parameters. So when you speak about the geographic location of the properties, who are the actual, whether it's middle income, lower income, a mix of both, all these things matter when you're looking at the end of the day, what this product actually provides. And this basic structure actually gives you a full view of the key things that will impact at the end of the day. Because no matter how pretty it looks, it comes back to performance and payment. It comes right back to that. You can create it very nice with lovely language. It goes right back. And that is the issue that happened when we had the financial crisis. Is that people got very sexy and forgot to go back to the premise, where did this actually start and what's happening there and how is it concentrated within the entity and within itself. So I think we're coming to providing that information today of the concentration between the different risk parameters. I think that is pretty good, and it's good information for any investor to have.
With regards to risk, anyone wants to go in more in depth?
Well, like any security in the market, there would be risk because nothing is guaranteed in the financial markets. But historically, residential mortgages are considered one of the safest in terms of all debt instruments outside of government paper. And that obtains not only here, but even abroad. And you would have seen how quickly the housing market would have recovered in the US after the collapse in 2000 and 2009. But one has to understand when we speak about risk. Now, the product itself is not an unattractive product. The product itself is not deceptive. One has to understand that this simple mortgage cash flow could be broken up, as it has done in the past, into 16 different cash flows to create that waterfall stream. And you have to understand that if you decide to purchase the cash flow at the top of the waterfall, so as soon as you pay, you collect immediately. You are a low-risk investor. But if you want some more juice, you want a higher return, you want to wait until the others have collected their cash flow to collect the residual cash flow, and in return you get a higher overall gain, then that is your option. But you have to understand that you are taking higher risk than people higher up the waterfall. This thing is so well structured that you can select where you want to be in the risk return profile based on the cash flow priority. Take a dog, for example. A dog can be beautiful, it can be a pet, it can be a watchdog. A dog can be a vicious dog. Does it mean that the dogs are bad? These have stable cash flows. Where do you want to sit in the waterfall will determine the risk that you accept. So knowledge of the product, to me, is an inherent part of the analysis and the decision. So the mortgage that the banks give, they collect one cash flow. They're happy with the risk because they know the underlying collateral is safe to a large extent. When you look at the mortgage-backed securities, as Osman said earlier on, they have qualifying mortgages, which is the premise for mortgage-backed securities across the world, including the US. Qualifying mortgages would be the ones that will be selected to create the pools, and then the pass-throughs like Fannie Mae and Freddie Mac and so on will now buy them and issue these papers. So when you look at the crisis, they deviated from these qualifying mortgages because everyone wanted piece of the action. They believe the market has no end. So they've decided to move from these qualifying quality mortgages and began to buy the subprime. Because according to finance, the bigger fool theory, if you purchase something that's overpriced, then you're a big fool. But there's a bigger fool on the other side waiting to take it off your hand. And that went on for years. But eventually it came to an end.
And I just wanted to chime in there in terms of the critical differences between that environment versus what we experience here, right? Because our underwriting characteristics have traditionally remained consistent, right? In terms of the banks and any other institution issuing mortgages, they have a core criteria that they look for, right? Yes, people now might give you the low rates, and they might carry your financing up to 95%, as the case may be. So that means they might reduce a bit on the loan to value. But bet your bottom dollar, they sure want to know where those cash flows to repay coming from. They want to see a job letter, they want a pay slip, they want to see if you're self-employed, they want to see your financials. And if you talk to somebody, some self-employed persons, they might tell you the only thing the bank can ask for is bad type. You know, in terms of what they want when the banks are going through the mortgage origination process. Right?
Let me just add one more thing to the risk. Because we need to separate the U.S. experience from TNT. Now, in the U.S., prior to the crisis, the average time a homeowner keeps a home is 5 years. And I don't think that changed substantially post-financial crisis. They see a house as an investment. And if the equity reaches an attractive level, they're prepared to flip it and walk away. Another thing, they trade up as your income increases or family grows, they trade up from one to another. So they sell the house. They may relocate because of jobs, so they have to sell and buy. Whereas in TNT, a house has a different interest. A house is a place for the family. It represents stability. So they are prepared to go all out to meet those mortgage payments, to keep the house, as opposed to the US or other places where they can walk away because the law allows them to declare bankruptcy and they can walk free, lie low for about 3 years and resurface. Over here, it's a different culture. And that reduces the risk to a substantial level. If you look at the total non-performing loans in our banking sector, it's in the range of 3 to 3.5%. And residential mortgages have the lowest delinquency. And if you look at the regulatory bodies, they consider a delinquent residential mortgage 180 days in arrears, whereas any other loan would be considered in arrears after 90 days. Because the homeowner has a different culture, a different appetite, and a different commitment. So the risk is extremely low to other asset-backed securities.
And that makes a lot of sense because it's a cultural thing. And when you have a cultural base underlying your risk factors, you have now a human side to it, something that will make you want to stay in. And in Trinidad, we have a short supply of housing. So when you do get a home, you're holding on to it. And the middle incomes are a critical part of that. The government sort of takes care of the lower income side of things. So when you have the assessments, I looked at a bit at the product and the assessments that were being looked at as part of the basket. And they're taking the premium. The premium product is what HMB is taking to securitize. So the risk factors, as Brackett was saying, kind of comes down on that. And so when you're looking at TTMF mortgages, that is made up of government-supported mortgages, plus also the working normal customer, you get a dispersion there immediately, right? So if as an investor, if you want to dig further and say, okay, fine, tell me exactly, Osman spoke about how they broke up the concentration based on geography and all that sort of stuff. You're free to ask. You're free to ask, give me a little bit more information on that and get comfortable with it. But the mortgages are normally in the financial sector thought of as what they call the low-hanging fruit, next to cars. Right? So this initiative is definitely supported, and it's definitely one that should be, the education that's being done right now, I think that is very important, that HMB is doing this. Let it not just be the best kept secret for the institutional investors alone, but that you can have others getting more involved in it and understanding the end result of it. It's not just the investment for you. It's just not just the underlying risk. It's not just that you can choose where you want your bucket. So it's become a very good portfolio management tool because you can decide wherever you are in life, which works best for you. Even take part in each one of them if you so feel, right? But it also allows the supporting of the economic growth with respect to the housing sector, which is their mandate.
In terms of moving the discussion along a bit, Trudy, as the president of the Securities Dealers Association, mortgage-backed securities and the role in the from a capital market point of view, you know, what opportunity-wise, how would you view it?
All right, when I go back to what I said a bit, it's given another option to the investor with respect to their portfolios, whether it's the institutional investor or the individual investor. And that is important because sometimes as investors, we don't understand at the end of the day, we're investing in businesses. And businesses is where the circular flow income starts to funnel, whether it's through the employment or whatever other factor. So when you have this and this now treatment with mortgage, something that is very familiar. It's not something that is difficult for somebody to understand. What they have to understand is the underlying risk when they start to get protracted. 1 year, say a 1 year stance, most people can understand. When they start to get protracted, they start to wonder about different things, right? So you have to educate with respect to what is happening with respect to the collateral coverage, etc. But this fits in very good with into your portfolio management. I would not say, as I always say, concentration is key to any portfolio. So you don't look at something and say, oh, this return is good. So let me fill up. 90% of my portfolio is in this thing. And that's why I keep speaking to portfolio. It's a good instrument to put within your portfolio because it allows you to plan from whether you're a 20-something-year-old or whether you're a 40-year-old or whether you're a 50-year-old and you're planning you reach your retirement status. It allows you to plan along that whole spectrum. So I think it's it's a good product to be not just for the institutional investor, but also for the public, like the individual investors. So it fits in pretty well on a portfolio. And I keep stressing the portfolio focus because we don't want this is looking good. The Prakat said the risk is extremely good. So let me fill up my portfolio on these mortgages. I understand this. No. I always say when you're looking at your portfolio, always assume that something could go wrong. It could be as safe as you think it is. And all you must be able to do, and when it goes wrong, is say, ouch. It shouldn't be, oh God, and here comes the government to help me. You know? So I think it's something that should be considered within a portfolio approach, where the institutions may better understand it in a portfolio approach, but the individuals to understand how this could really add to their portfolio and put some value in there. Right. Rakesh.
Well, it will be a welcome to the capital markets because it will offer a broader spectrum and perhaps drill down a bit deeper. What I also like about the mortgage-backed securities is that it brings about a certain level of financial disintermediation as well. So greater value will actually come to the investor as opposed to the strong financial intermediation that exists now. And that by itself will create the awareness and I think would lead to greater product offering and expansion in the capital market. So I think it's a commendable move.
Okay, I mean, from our perspective, right, it was really about recognizing that there's an opportunity here. Right? The HMB Act allows us to seamlessly treat with mortgages, and we think there's a real opportunity and value in terms of developing that mortgage-backed securities. Okay.
So in terms of that, Mrs. Talsford in particular, what would you say are the actions required to develop market acceptance of this product?
Education, which is exactly what is being done here. Education, because what you don't know, your fear will be your first response. So education with respect to what's in it for you, and just not what's in it for you, how do you contribute to the broader spectrum? What is the underlying risk? And every other components of the actual product. But basically education, sharing the information. That is what is important because they wouldn't look, anytime somebody thinks mortgages, they think financial crisis. It still hasn't been far removed because there was not an understanding of how that actually happened. So you look at the thing and you say, it's bad, but you need to go a little further. So it will be a lot of education with respect to providing information out there. And don't think that the public side of it is, just focus on institutional investors and, because they can give the bulk of it after it's 200 million. And not think of the individuals. The more you bring an accountability within our society for how we contribute to what happens here, it matters. And why can't the capital markets do that? When people invest in capital, they're investing in businesses. They're investing in things that impact the economy. Why can't we start putting that message out there so that then impacts how people view the capital market as an alternative to the normal spectrum of investments, and see how within how they can do it on a prudent risk management kind of platform. So it don't seem like, oh my gosh, the capital market, I don't know about that. I just put it in a deposit or I put it in some mutual fund, or, because everything is scary. We need to educate for them to understand how everything comes back. Because you have a housing shortage, right? We can't meet the demand. How does this impact that? How do you become responsible? What's actually happening with you? It may end up that you create the pool. But once those funds are flowing, then you can supply. Right? So it's that education that the capital market has not been able to actually put out there. And we are hoping to do a little bit more of that. Right? Hence the reason why I took time off and I'm sitting here today quite happily, because we really think that is important. And we have also linked with the TTCIC, and we intend to also link with the central bank. They also have an arm that are doing the educating, that we can put the capital markets in between there and get a little bit more information out. But it is a viable option. And we are seeing more individuals being more receptive to things other than just those that are listed on the stock exchange. And applause to the first SME listing on the stock exchange. That's a start. Right? So I think it's really important that the information get out there. Otherwise, you're just dealing with fear or ignorance.
And what would you say are some other comparable securities?
On our market, you basically have the repos, you have bonds, and so the mortgage-backed securities, there really isn't the mortgage-backed securities in this format on the market. I know one other entity that would have done a bit of it before was quite successful with it. But generally, it is not there. And I always have a problem dealing with comparables, because comparables comes back again to risk and individual portfolio, where you want to be. So I could say, okay, fine, I'm going to go with this investment because it's giving me 15%. Do I have a risk appetite for that? What is the term of that? What supports it? Right? So when you're looking at comparables, you have to look at everything. Most time people just look at interest rates, and that's why they end up in trouble. Because they just say, oh, this give a better rate. I'm going with that. Or I see this entity have a mutual fund and they're giving this rate, and this entity has it and they're giving this rate. I go with this. Nobody is really looking at the underlying risk. And that is the message we have to get out there. So people to get educated and understanding that risk and return go hand in hand. And at the end of the day, concentration covers everything else. So it's critical that what message we actually carry out there. Even in getting this product out to the market, it's always important what is the message that we are taking out there.
And to Mr. Pravard, what would you say are the unique features this product offers?
Well, just to build on some of the things that would have said by the panel before, in terms of unique features, right? We see that we have a consistent stream of cash flows come through from our mortgage, right? We basically would pay investors on a monthly basis, right? So let me say you're an individual investor, a pensioner, or near retiree, and you are looking at how you could plan your cash flows heading into retirement, right? Then you could buy a suitable investment opportunity in a CMO, right? Unique features would also include the type of collateral or security that backs the product, because most times investors would gladly just run to a government-backed or a government-guaranteed security, right? But building on what Prakash was saying in terms of culture, right? That need to want to hold on to your home, right, I would say gives an increased level of protection, right, that is away from some of the political and macro interests that are out there.
Mr. Ramlakan, want to add?
Well, based on the prior two questions, like what is required to promote the market? Yes, I agree. Significant amount of education is required. But going beyond that, a few things I think need to be put in place as well. You need to have strong secondary market players. I know earlier on, Osman mentioned that HMB will step in to buy. You need to have a market maker. You need to have that in place. You need to have your targeted customer. You just, in my view, you don't go out and promote the product to everyone. You need to have your target market, who you think will be interested in this. You need to understand your client, who will be interested. You promote it to that target market. Getting a credit rating would significantly improve the confidence in the product. Another interesting one, I had a few points written down here. The performance of the product. We have discussed it verbally. But let's say after a year, 2 years, and you start seeing performance measures, how MBS have performed relative to treasuries, to corporate securities. And I think over time, the confidence is going to build. It is different from other products because you have so many structures coming from one single stream that no one size fits all. You can select the size that suits you. And as you build your portfolio, you look at what piece of the puzzle is missing that could be available from the mortgage stream, the mortgage-backed securities. So you can combine that because the mortgage-backed securities have the benefit of reducing your overall portfolio risk while giving you a few ticks on your return. Now, I'm not going to say that it is suitable for everyone because the individual or the institutional return objectives and risk profile would vary. But what I can tell you from research, these products generally fits in well with most investors.
And to Mrs. Telesford Pear, what do you see as the future of this product?
If it's marketed right, this is something that should be able to become cemented in our product profile for Trinidad and Tobago. What Prakash said about the information dissemination with respect to the performance of the actual product will impact that. I don't know how HMB plans to do that, but to as it goes on, so okay, fine, this is how it has been performing. So, and that, of course, assists in also in the secondary market being built. Right? So I don't see this product as being something that is just a one-off. This is the second one that they're doing, actually. But I think, but how they're approaching it right now, I think it could continue.
Just to respond to Trudy in terms of how we would disclose information, right? We actually do have some, we made some commitments to the SEC when we were registering our first CMO, right, in terms of disclosures. So we do have on the bank's website the performance of the mortgage portfolio, inclusive of the aging analysis for the mortgage pool, as well as how the tranches are performing and how they are paying down. So, I mean, it's something that we intend to hold on to as we develop the product, because ultimately, the idea is that we would drive the product for a greater level of market acceptance, and to do so, we too need to give the investors as much of the information as they need in order to satisfy them. And sometimes when I speak to my clients, right, we would have had a number of individuals come in and invested in some of and invested in the CMO, I always tell them, I want to ensure that you sleep good tonight, right? Because after they make these investments, actually they come to you, when they come into the office, they know what they want to do. They know they want to invest, and they might have a fair idea as to what they want to invest in, right? But they have an even better idea the rate they want, right? So is about getting them to a point where they could live and they could sleep with a rate and an investment opportunity in a tranche that is comfortable for everybody.
Anyone who wants to?
Well, you want to know what we see in the future for? I could see mortgage-backed securities owned by everyone here directly or indirectly through their pension funds, through the mutual funds in which they invest, and even the banks that hold their deposits. So indirectly, I could see exposure right across.
And beyond exposure, education, awareness, as we're doing this morning, how do you think these goals can be achieved?
Well, with respect to the education, you said that this is the first installment. Yes, and I think reaching the right audience through the right medium. Now, I teach some of this, but we have very little examples to do. And a lot of my students go out there in the industry as well. So having the knowledge. And I could tell you personally, I would love to have someone like Osmond come to my class and make a presentation to give the practical side of it outside of me. But I think you need to hit a lot of these finance journals with publication, create the awareness, build the product, keep it simple, track the performance, do the road show. You have to go there and sell it because you have to treat it as something new. Even though it has been reintroduced, you have to treat it as something new. And you have to divorce this from everything else that happened across the world. So it will take some effort. I have no secret formula other than to tell you have to keep hitting the pavement and do so at the right places. Go at the big ones. Go at the big players. When I look at it, NIB, I know that's your parent company, but they have $3 billion sitting in banks. Life insurance companies have about close to $900 million in banks. Pension funds in the aggregate have about $1.2 or $3 billion in cash and cash equivalents. And then the individual, all of them come into the banks. Banks, as of about 6 months ago, banks have around $17 billion in cash. Of course, they need a substantial amount for their daily operation. The excess reserve, the excess cash, excess liquidity in the central bank is about $4 billion. Now, that is a small slice compared to the mortgage potential because we have a demand for at least 50,000 houses. Let's say 800,000 a house. That's 40 billion right there. So there's a huge market waiting to be tapped. And you cannot tap that from the traditional mortgage or originators. You need to have the secondary mortgage. You need to have these securities created so that liquidity comes to the market to start funding those houses that need to be constructed. So there's a huge playing field there. And guess what? Basically, one player is out there. The game is yours.
I'll add to that, let's not forget the brokers. Your friends on the board. So that they start to see it as an integral part of portfolios.
Well, in the distribution of our products, especially the CMOs, we have engaged some brokers, right? What I would say is, in talking to the brokers, they would have run upon some of the same issues that brought forward this here panel discussion, right? Education and awareness, right? And bank has since committed to doing more with respect to educating the market, bringing a greater awareness for the product, and we expect that the brokers will continue to participate in the distribution of our security.
I like to say one thing though. You know, you say they came back to you with the same issues. If you don't believe in something, then you can't sell it. So we need to look at the depth of belief and understanding within the brokerage community. So that, because all these things that are coming back are not because you're very close in the structure. It's not like it's reaching out, hasn't reached that secondary
Right.
market. Right. Once there is a clear understanding of it, they can then, once they're doing a portfolio approach, maybe that is something we can look at.
Definitely.
How do we get that belief system strengthened within the group? Because they are the first ones who interact with outside of the bank, so that interact with investors. They are managing AUMs. May not be as huge as the pension funds, etc., but they do manage AUMs, and we have to start at home. So that's another space that we could look at. See what
Well,
we can do
again,
at
it's
the
a
start.
cultural
thing,
challenge.
yeah.
Before we move on to our question and answer segment, would anyone like to plug in anything from our panel? No?
Just generally, this is really good for the securities market. It's really good to see how the capital markets has evolved, because generally most people just, of old times, they felt mutual funds were called UTC, just like bleach is called Clorox, all right? And they would put 100,000, 200, 300,000 on a deposit, knowing that only 75,000 is secured, but that felt good, all right? And basically look for rates. So you see a good rate, you forget what is underlying. Just, oh, there's a good rate, and the person saying, yes, you can get it, and don't worry, this risk. No, this risk won't happen. So there's a lack of education as to how you create a portfolio. So it wasn't being done in a portfolio place, and then you just simply go and buy annuities, because that will take care of your pension, or the government will pay your pension. It is good to see when the capital markets bring different things to fore. And we'll find the young people that you're lecturing will be, they have a little larger risk appetite, and they're a little bit more innovative and more creative and comfortable with that space. But it is very, very important that the capital markets in Trinidad be seen as being viable and being important and being critical to what happens, and not just a place where you just have a government bond. People know maybe a treasury bill, you know, those kinds. But that we understand that even in that, and that's why I'm very happy for this product, because even within that space that we cry for most, that politically is always charged with, okay, who has a house and who does not have a home. This is a way of actually getting it done and understanding that you're part of it. So I think even for the institutional investors, which I agree with your analysis, they should get that. But it's how we put it across, and to make sure that they then can, but they have to believe it. They then can carry it on and remove that stigma of that financial crisis. So this is, information education is the only way to go, but it is really good for the market when products are being developed that gives options to investors of all spectrums.
Diversity. So we'll now open up the floor for questions to our panel. We should have a roving mic. So by way of hands, not all at once.
It's very quiet.
Thanks. Good morning. Is it on? Hi. I just wanted to know how the secondary market will be facilitated for these securities if you don't want to hold to maturity.
Okay. In terms of liquidity into the market, right, HMB would make a market for individual investors, right? So you're an individual holding CMO securities, right, wishing to then sell, could come to HMB office and say they want to sell, and we would buy back the security, right? In that instance, the individual will face price risk, right? Because it's not a fixed. Well, even though it sells at let me say $100 per certificate, right? Price is variable over time, influenced by interest rates. But so the investor does face price risk in the event that they want to exit the security prior to maturity. But the bank will make a market for the individuals, right? For institutional investors, we think that given the number of players in our local market, we would think that institutional investor could easily reach out to a broker or a fellow portfolio manager investors at another institution and be able to dispose of the security.
Osman, is there a limit to how much you will buy back in any given year?
Yeah, yes, good point. Right, so there is a limit to how much we would repurchase from an investor at any point in time. And on an annual basis, that limit is 1 million TT.
Anyone else? Thought I saw a hand. No? Yes.
Hi, good morning. My question regards to how do you buy into the fund? What are the requirements for purchasing these securities if you are individual or institution?
Okay. As an individual, well, then you would, either one, individual or institutional, you would go through the bank's onboarding process, right? And at that point in time, then you would see what is available for investors, whether it be, well, in terms of what tranches are available for a security. Right? And at that point in time, you could come in.
Okay. So is there like a minimum investment amount or what?
For our CMO product,
Yeah.
the minimum investment is 5,000.
Okay.
Right? We also have a mutual fund, mortgage backed as well. And in that instance, the minimum investment amount 500.
Okay. And are there any residency requirements or anything like that in terms of investment?
No.
No? Okay. Thanks.
Any other questions? No? So to our panelists, if no one would like to add anything else, we have now come to the end of our panel discussion and we'll move further to our formal near close of our program this morning. I will now like to invite to do a product presentation, Manager, Commercial and Corporate Credit, Ms. Rolda Rush. Please welcome her.
Good morning again, ladies and gentlemen. Welcome again to the Board of Directors, our honored guests, Mr. McPhee. We just want to say thank you for being here with us this morning, and we'd just like to share with you what the Home Mortgage Bank does in terms of mortgages, commercial lending. You would have had a brief discussion just a short while ago on the investment side and what the bank can do. And I'm just going to quote you quickly on the commercial mortgages side. But before I go to that, I would just like to talk about quickly what has been done before and what has already been discussed. What the Home Mortgage Bank does. Of course, it was mentioned before that we have been in existence for over 30 years, and our mandate. As you can see, our mandate was just fulfilled this morning when we talked about to develop to develop a mortgage market and maintain a secondary mortgage market in Trinidad and Tobago, which was discussed by the panel this morning, to contribute to the mobilization of long-term savings for investments in housing, again, which was discussed again by the panel this morning, and to support the development of a system of real estate, property, and housing finance and provide leadership in the housing and home finance industry. Again, we saw this on the investment side this morning. Also, too, we promote the growth of the capital market, again, which was discussed by the panel this morning. And of course, my side to promote and develop the commercial and corporate credit market. So I'll skip this quickly because this is just an ad basically, and I'll talk about the types of financing available to private developers and contractors. We have been hearing a lot of talk about the housing shortage in Trinidad and Tobago and the government incentives to try to encourage the development of houses and the construction of houses. So we at the Home Mortgage Bank provide different forms of financing to meet those needs. So we do offer project financing to finance the private sector and real estate development projects which will generate income to repay the debt. So if you have a type of financing that you're looking for real estate development, we offer that type of service. We also provide revolving loan facility, which provides a sort of working capital for construction projects. We also provide commercial land loans to purchase land for commercial purposes, as well as commercial mortgage loans to purchase property for commercial use. We also do look at the government incentive side, where we do offer the PPP type of financing, which is the private sector partnership program, to finance the real estate developments as well as the housing incentive construction program. All these are under the government housing initiative to provide affordable housing for house owners. So what are the benefits for I guess, having these types of facilities? We do offer free qualifications, competitive pricing, no penalties or lump sum payments, which we allow clients to make lump sum payments towards their loan. Of course, if they want to pay it off before the maturity date, that's an option that can be utilized. Our term of financing is 15 years, flexible repayment term, and we do offer personalized attention, something that is not there, but we do provide it. We also do provide constant visits and advice to contractors. So what are the requirements to commence the process or to start qualifying for these types of facilities or any one of those types of facilities that was mentioned prior for these types of financing? So the requirements: you must have a business plan, which gives a very detailed understanding of the project. We also must include a cash flow projection and a marketing plan. A marketing plan is critical and essential to make sure at least that the houses built can be marketed and sold. We want to know what the company does. We want a comprehensive profile on the company as well as references on the contractors that will be associated with the project. Of course, financial statements are critical. We need to know how the business is going to pay for these houses, how it's going to be financed from the cash flows, and we want to know how the company has been performing over the last couple of years, or at least 3 years audited financial statements we need. We also need to get the title deed of the property to be mortgaged, and of course any CEC clearance certificate, that is also necessary. We do site visits, and of course valuation reports is also critical. There are other requirements as well that we would need. We would need all the statutory approval, town and country approval, EMA approvals, WASA clearance, everything. We would need to have detailed contractor's estimate. This is important because we need to know what is the actual cost of construction, a quantity surveyor's report, projected valuation report, and of course it is important for us to have references on the builders. We need to know that they have done that before. We need to know that they have the experience and the expertise to do the necessary construction, and of course building contracts if applicable. Now, someone just mentioned KYC. KYC is important in all aspects of every type of financing or investment. So on the contractor or on the individual person who is coming to do or who is coming to ask for the financing, we would need to know this person, who they are. If it's on the company, we of course will ask for all the incorporation documents on the company. We'll ask for information on the directors and stuff like that. So we do our own type of KYC to ensure that all the necessary legal and statutory requirements are met as it relates to the company. Of course, these are some of the projects we've done before. Some of them are still in progress, some of them have been completed. So just to give you an idea that we have been doing this and we've done it before. And for where we're located, we are now located at the second floor of the NIB building, that is around the Savannah. And we only have one office. Right now, the South office no longer exists, basically. And this is our contact information in case you need any other information on the loans or on investments as well. We can be contacted at this information. And this is the team who would be the ones assisting you. On top, that's me. I have Adwin. Adwin, could you please stand so they could see who you are? And Andel. And Property. These are the people who would be assisting basically with any assistance or questions you would have regarding mortgages. So this is basically my presentation for the morning. Thank you so much for listening. Thank you so much for accommodating us. And any questions or any questions? And of course, we can be found on the online as well. So thank you very much for listening.
Thank you very much, Ms. Rush, for contributing to our education awareness this morning. And I must say, I always, in whatever walk of life, our name precedes us. So I humbly apologize publicly to Mr. Prakash Ramlakan. I don't know if I said it correctly in my mind, and it did not come out that way, but yes, to Mr. Ramlakan and to Mrs. Trudy Telesford-Pierre. When we carry double barrels, it always poses a challenge. So it gives us pleasure this morning to have had such a panel discussion, and as a simple gesture of our thank you from the Home Mortgage Bank, we would like to present both our external panelists with a token of our appreciation, and I now call on Mr. McPhee to do the honors. Ladies first, to Mrs. Telesford-Pierre. And to Mr. Ramlakan. And of course, in anything we do, we must give thanks. On behalf of the Home Mortgage Bank, we would like to extend gratitude to the Trinidad and Tobago Chamber for hosting us this morning, for having that vision alongside the Home Mortgage Bank team to conduct this first and certainly not last session where this education campaign is concerned. We would like to say thank you, of course, again to our panelists, including Mr. Pravat this morning, as well as to the members of the media for coming out. I know they had to run out very quickly, as well as no function, no event will never be a success without an audience. So we want to say thank you very heartily to all of our attendees this morning for coming out, for being here, and especially on a Monday morning when we know we have all those emails to attend to and everything else. We want to say you all have made it a success, and we hope that your continued support will be with us on the drive to ensure that this product becomes all that it needs to be. So I now bid you all a farewell, safe journeys to your respective destination, and please stay back at least for a little bit, network and mingle. Thank you once more.